to be launching on Zoom. Will, you're going to also put the disclaimer in before we start?
Oh, I love the disclaimer. Anyone who's looking and seeing the third person, that's Chris Marcus. You're going to love hearing his story. It's an amazing one. Chris, you want to say hi?
Hello there, folks. How are you today? I'm putting my phone into airplane mode so we won't be distracted.
Yep, that's a good thing.
It is quite a pleasure to be here. I sure appreciate what you guys have built. I use the Market Chameleon myself often, and got a lot of projects coming up that will be continuing to use it. So a pleasure to be here with you guys today.
Hey, thanks, buddy.
Thanks, Chris.
All right, here we go. That is 6 o'clock. Are we ready?
Yep.
All right, we're launching. Hey, chameleons, thanks for joining us. You have a very special guest joining Dmitry and I tonight, and it's Chris Marcus from Arcadia Economics. Before we get started, let me share my screen real quick. Yep. Dmitry, you see that?
Yeah, there was like something over it, but basically, everyone, it's a disclaimer. Remember, Market Chameleon, none of us were not registered investment advisors. We're not broker dealers. We're not making any recommendations. Basically, we're just sharing ideas. If you're going to do any types of trades, then consult your broker or investment advisor. Again, there's the disclaimer.
There you go. Now, everyone, I'm Will McBride. I'm from Bucks County, Pennsylvania. Make sure you can hear us. Let me know if there's any problems with the sound. I know Chris, Dmitry, and myself can hear each other. Also, we have a chat. It's going to be in the right-hand corner of your screen. Let us know if you're hearing anything interesting, something you want to ask Chris. We have a Q&A, question and answer section also at the bottom. Put the questions there. I'm going to launch a poll. Have you traded options on the SLV or GLD before? Again, this is a special episode about the silver market. Chris has an amazing story he's going to tell us. Chris got his start. Well, I guess you got your start in finance at Wharton, right?
Oh, even before that, I figured the easiest way to make an income, since I had to get some job, or so I was told in New Jersey growing up, was finance. So I got in there in undergrad and went to Moody's out of undergrad. And yes, if anyone's wondering, that is the same bond rating agency that has U.S. Treasury debt rated AAA, their highest possible rating, but we can get back to that.
All right, let's not jump into your story too fast, Chris. Anyways, Chris ended up going to Wharton and then joining a big firm out of Philadelphia in the options space, Susquehanna. It was the dark knight, the arch enemy to anyone else who was down there, like Dmitry and myself. And did you spend time in Philadelphia on the floor? I forget.
Never on the floor there. For Wharton, I was there, and for their training program in Bala, but did not trade on the PhilX.
So then he made his way to New York and worked on the NYSE on their option space and the Amex for years, and then went out into the real world and started this business he's doing now. He's got a podcast with, is it millions of viewers, millions of subscribers? I mean, it's a large podcast and YouTube channel. I forget the numbers, but pretty incredible what you've achieved there. And he's an amazing story. And he's just written a book. I'm going to put out right now in the chat Chris's YouTube channel. Everyone should subscribe to that. Also, please subscribe to our YouTube channel and give us a thumbs up. And Chris, with that, we'll get you started. Tell us your story, your silver story.
Well, again, I appreciate you having me here, Will. I don't know that back in those days, even when I was at Wharton, taking the Chinatown bus back and forth from Philly to New York for trading interviews, I never expected to find anything quite like what I've stumbled into. And it really began, I was trading equity options for Susquehanna in 2007, 2008, when the mortgage bubble started unraveling. At one point, I remember thinking, gee, I just come from business school, was working on a trading floor, that I was kind of the guy that was trained to see this type of thing, was completely blindsided by it. But when I found, I thought it was odd that Bernanke and Hank Paulson were talking about how it was the perfect storm and no one could have seen it yet. Basically, everyone I found who was able to see it in advance, wrote books about it in advance, talked about it years in advance. They were all talking about how basically you print money. Eventually, people aren't morons. They see that and they revert to gold and silver. So it was interesting. There was about 2 years in between 2009 and 2011 where I'm working at that point on the New York Stock Exchange, running an option pit and really reading a lot about gold and silver. You have QE1, then by the time QE2 gets launched in October of 2010, I was ready and had a bunch of SLV and GLD options on the way up to $50, and when gold was on its way up to 1900, which that half was obviously a bit more fun than the way down. Although what struck me as odd was that you have US getting downgraded, you have debt skyrocketing, you have something called quantitative easing. And to me, there's some point at which the dollar as priced in metals doesn't come back. I mean, that's what's happened every time throughout history. And when I saw silver get up to $50 and then on a Sunday night just get pummeled, got knocked down $6, and never really recovered, has been beaten down ever since then, despite more debt than ever. I mean, if you thought the housing bubble was big, it's exponentially more debt, exponentially more out of the Fed. And really that book that you mentioned that I just put out, The Big Silver Short, was almost an attempt to disprove my own theory or find what I could be missing. So as I started my YouTube show, I was interviewing people and recorded 15 interviews with, David Morgan, Craig Hemke, Dave Kranzler, Rick Rule, the best silver experts in the world that I could find, to see did the price come down specifically because it was manipulated and bankers sold a lot of COMEX futures more than exist with physical metal. If that's the case, then if natural demand was driving the market to 50 and it only came down because of, a derivative manipulation, then if that's accurate, I've seen 50 as somewhat of a floor. It's led me into this fascinating silver world. Even beyond the finance, it's quite an intriguing story. And today we can talk about some ways I approach it using options. Happy to also take any questions. And I know Will and Dmitry are going to show us some cool features that make the whole thing easier.
So when you got started on this journey, the book itself, what compelled you really to sit down? I mean, the thought, thinking about taking that time to, I mean, you're that passionate about this silver market exploding, obviously. I mean, that you think there's going to be some gigantic move in silver. Is that the case? And you wanted to share your ideas and see how the market responds to it? What was the genesis for the book?
Well, really that I saw The Big Short Part 2, been watching it play out for the last decade. It's an incredible financial opportunity if you approach it right. Even if you're not into investing, if you like the movie or the book, The Big Short, I mean, it's playing out again now. It's the most darn fascinating thing I've ever seen. And it was something that I loved studying and researching, and for years was thinking, all right, how can I turn this into something that I can share? And because I guess, to be honest, part of my exit from the trading floor, I used to walk through Occupy Wall Street on the way to, I would go right in behind Will there. The later days were right close to the exit where I would walk in. Remember there was one day walking home through Occupy Wall Street, I saw one guy with a shirt saying "A job is a right," and he was standing next to a guy holding a Ron Paul sign. So I also saw that there were a lot of people who were frustrated. The system is, it's disturbing in ways how much it's taking advantage of people. I think that's unfortunate to the degree people got clobbered during the mortgage bubble and wondered how come no one had warned. To whatever degree I was able to see this, and so many of the guys trading around me couldn't. I just felt it. A, there was some obligation to speak up, and B, thinking, gee, if there's some way I could make this and my love of studying this subject into business. And fortunately, that's what happened. So it's really nice the way it's come along.
Very cool. My memory, and Dmitry, I don't know what your memory of Occupy Wall Street is, but I remember my falafel guy could no longer park his truck around the square. He got booted.
Yeah, you can't have that.
Dmitry, you remember anything about Occupy Wall Street, walking those streets at that time?
I don't know. I don't think I remember. Were we still?
Yeah, we were still on the Amex. We were
Were
about
we on the Amex?
Yeah, we were about 8-9 months before we came back to Philadelphia.
Really?
It was a real
Yeah.
strange time down there. I mean, yeah, I would walk down Wall Street to get to a ferry to get home every day.
Yeah.
And it was somewhat like a carnival, it was very strange, very strange.
And it's understandable that people are a bit ticked off. I mean, you look at just measuring the dollar in gold to today's price, let alone, which I would say is highly suppressed relative to anything that, measuring the dollar supply. I mean, but you're talking about the dollar losing 98, 99% through inflation. So yeah, when people are trying to figure out how to pay for healthcare and all these other things that become so darn expensive, and and it's also I think something that hopefully on the other side of this leads to a lot of great things. I mean, without this dollar inflation and all the places it's wasted, I mean, imagine if instead of all these choppers and tanks and missiles, it's like people were getting nicer, working less, that's really where it comes out. So it's, a lot to it. And I think that's why people get so passionate about silver, which is also one of the reasons why I think you have a short squeeze building in the silver market. And I don't think a lot of the people who actually still own silver now, I don't think have any intention of selling their physical silver anytime in the near future. And we can also dig into some of the fundamental factors, especially it's very fascinating what's happened during COVID this year in the silver market.
Well, before you get started, we got one quick question on YouTube, which may help you lead into this. He says, do you see a pullback of precious metals before taking off? He's talking about with money velocity tanking, it looks like technical chartists are in agreement and deflation that you may get a pullback before you'd get a rally, was the question from someone. I don't know if that's something you want to touch on before you get started, but it was a couple people were talking about on YouTube.
Yeah, I think it's absolutely wise to be prepared for pullback, perhaps pullbacks, plural. My guess is that whenever there's a bigger fracture in this dollar scheme the Fed's running, I expect we'll have times where people will still flock to dollars and treasuries, call it a safe haven, even as the Fed's going nuts. So being prepared for things like that, I mean, none of it's going to be 100% or 0%. But one of the things with the silver market that I find crucial is structuring your trades so that you hedge out that time element as much as possible. There are ways to do that, even with options. We can walk through how today. Although one other quick comment, you mentioned the falling velocity. That's something that I've actually been reviewing. The Austrian school has a different view. They're of the mindset that once the money is created, that's the inflation. Now, the velocity will perhaps change where it's directed to. I would say we have a lot of inflation now in the stock market. And keep in mind, just because the number is lower, let's say the Dow Jones went from 29,000 to 25,000. I mean, it could still be highly inflated. Maybe it otherwise would have gone to 20,000 or 10,000. So there's a lot of inflation out there. A lot of it's been exported abroad with all of these dollars that are in other places. You know, it's not like life is getting cheaper here now. And, but anyway, to your original question, yes, I would expect and always be prepared for that. I think there's going to be one day when it doesn't come back. And to me, you know, that's why I spent so much time seeing, am I sure that at some point this doesn't come back? If that's the case and that's your bet, I don't want to get too cute on saying, well, I think I could get a little bit lower, but having some sort of strategy in place so that you can hedge that out. Anytime you hedge out the areas that aren't the core strength of your thesis, I think there's something to be said for that.
All right, great. Well, show us some of those things you're talking about, what you're seeing out there.
All righty. Well, I'm going to share my screen here. First, for folks who may not be following the gold and silver market too closely, we'll go through a couple of quick fundamentals. Here is Ronan Manley of Bullion Star, who's done some great reporting this year. And partly, we're seeing signs of smoke coming out of the gold and silver Enron warehouse. And I say that because essentially you have numbers, most folks think it's around 500 to 1 for each ounce of silver or gold. How many people own it? Nobody really knows for sure, but in the past couple months, you saw a couple of LBMA market makers blow out on March 23rd and 24th. HSBC announced a $200 million loss, CIBC $60 million. Deteriorating liquidity. Banks have been pulling back from the gold and silver market right at the time when they're heating up, which is a bit unusual. There's losses at HSBC. You have sharp drops, COMEX, open interest, a whole bunch of other things happening here. What's interesting is that the actual demand, and we'll stick to silver here. Here you have, these are the silver ETFs like SLV. This number is a little bit lower this week, but still 36 million ounces added over the past 4 weeks is quite stunning. And what I think most people would have no idea about, because very rarely talked about, here's a chart. The blue line shows the amount of metal going into the ETFs. This gray line shows the price of silver. There it is at 50. So it's kind of gone almost, you know, an awkward curved 45-degree line down, whereas metal allegedly added into SLV has gone up. About 60 million ounces was added to SLV right before it went up to $50. And you've had about 300 million ounces added in the past year alone. So there are people like myself and the others who study it who wonder if these numbers are real, because it's almost, to see that much metal go in, especially ever since the price got stuffed back during March. You've seen a surge in demand on the retail level. Here you see it, I'd call the ETFs institutional level. Meanwhile, the supply, I understand there's some degree to which demand is going down, although the supply is going down even faster as mines got shut down from Corona. Here you see falling supply. I believe this one is in Peru, one of the largest silver producers. So, I mean, it seems like we're reaching a break point where some of these issues are going to come to a head. And Will, would you like me to dig into an example of what I would actually be looking at?
Yeah, that'd be great.
So here, let me share my screen again. So here we have the Market Chameleon, where I looked up things like this. A lot of this started again having the options on. That time I was using GLD and SLV. I don't use them as more. I like using some of the mining stocks. I think you're getting leverage on them. And B, in the event that there's some sort of failure to deliver, maybe SLV has the metal, maybe they don't. There's a lot of people that would argue quite strenuously that they don't.
right.
To
So let me stop you so I understand. I mean, you're talking to someone who hasn't played in this space. You're saying that, and this is going over to your previous comments, that the silver market, what's being accumulated in SLV may not be showing up in actually the underlying. They may not be storing it or holding it. So because of that, there could actually be risk to the ETF at some point.
Yeah, there's counterparty risk for sure there. I mean,
Right.
when you see that blue line going up, they're supposed to be adding silver into their trust.
Gotcha.
I don't know. We can, don't have to dig into it now, but there's certainly legitimate concern of whether it's in there. I mean, JP Morgan's the custodian of SLV, and they're currently being charged with the RICO statute for manipulating the precious metals market. So whether the metal's there, they're slicing a couple basis points here or there. I like to personally invest with people that I trust because, on some level that usually just works out better.
Gotcha. So your play is actually to play the companies that mine the product. Yeah. Cool. Well, let's hear it.
Well, the quick reason on what you just said of why I like the miners is that you get leverage on the move. So make the numbers simple. Let's say silver's $15, costs First Majestic $14 to get an ounce out of the ground. So that means they have $1 profit margin, right?
Sounds right.
So if silver goes from 15 to 20, silver's gone up 33%, right? Whereas if silver goes from 15 to 20, the profit margin has gone up 6x. So you're going to get, there's obviously, that's a very crude model, but you're going to get some leverage on the miners. Actually,
wow, we're losing.
Doug Casey's book, Crisis Investing from 1979. Here's something that should excite option traders. The average penny stock between 1962 and 1968, when silver went from about $1.09 to $2.50, the average penny stock went up 150 times. So Will, can you tell me if you have options on something that goes up 150 times and your long calls that you bought for a nickel? It's like, can you show us your beach scene in the background there, Will?
That's a nice return. You're going to be getting, I don't know, maybe retiring to someplace like this.
Well, that's the thing. Back in 2011, I thought I was on my way. And if my theory is correct, then, hopefully at some point capturing that. But here's a great example that really got me thinking more about this and that I'm currently doing. So here we see First Majestic back in 2016. There was a rally in silver in 2016. And let's see if I got that one pulled up here. I believe that I do. Oh, that's 2011. Let's see. Silver price. Well, so let me pull up historical chart so you can see this. That was where silver got crushed in 2011, sending Chris's then option trading dream on delay for a couple years. But here we go with the 2016 chart. Where you'll see that silver rallied basically from $14 to $20 in 2016. Sorry, I'm a little slow with my chart here.
No worries.
There you see, started the year $14, got over 20. Personally, I wonder if you start getting silver between that 20 to 25 range. I've heard people speculate that derivatives get triggered at big banks. It is interesting when you see this was really the high ever since 2011. And then last year it got up to 19 a couple of times. We'll call that clearly speculation. By the way, Will, to your earlier disclaimer about the option trading strategy, by all means, what we're talking about here is highly speculative. So I'm not trying to fool anyone, or so by all means, be very clear what we're doing here. Well, though I think you can work the math out so you get to become the casino, because here we see, this is the first Majestic chart in 2016. So you see they were down at $2.69, and by August it was up to 18 bucks. So silver went from 14 to 20. You got that about 30-ish% move, or maybe a little more than 33%. And First Majestic went up 6x.
Nice.
So what's interesting is that, let's say, now silver now is at, what is today's silver price? It's close to $18.
Well, we're waiting for that chart to come up. One thing's for sure, Chris is giving away 2 pieces of silver, so everyone should hang on at the end of the show. I forgot to mention that, Chris, and you didn't tell me to mention your little nice silver gift. So he's going to have some sort of raffle at the end that he's going to share with us. So everyone hang on for Chris's.
Got, what are these? 2 Noah's Ark coins. Let's see if I guess there's.
I see them.
Very nice.
But,
They're shiny, like my head.
yep. So anyway, here you see silver is about 18 bucks, and First Majestic is at 942. So we can look at 2 levels of this. One, what happens if First Majestic gets to, or if silver gets to $50. But let's not even go that wild. Let's just say silver gets back around above 20 bucks and First Majestic were to do something like going up to 18. So if you pull up your option chain, which Will, again, I thank you for making the darn thing. For years, I had been looking for something. I was a little bit spoiled by Susquehanna's gear, and it's been really nice using this and having, since you guys traded, it's just different. Someone who's done it for years and knows the little finer things, not like other people can't build good things. But anyway.
Well, thanks for saying that, but it wasn't me. It was the other guy on this screen, Dmitry, who built this. I was just there to help. And one thing about the option chain, which we had a big discussion with Chris earlier in the week about some different stuff, and he was referring to it as the board, which I found super interesting, a little insight into Susquehanna. And Dmitry actually brought it up, which I thought was cool floor history. I don't know when, Dmitry, in like the 60s, 70s, 50s. I mean, you look at old pictures of the floor of the exchanges, they were actually writing prices on a chalkboard. So at Susquehanna, they still refer to it as a board when you're looking at it, which I think is pretty cool. But we refer to it as an options chain because Dmitry and I were with Timber Hill, and that's how they always referred to it. So there you go. So what do you see in that option chain, Chris?
Well, I'm glad that you like that we called a board. What would happen is that, whoops, let me pull my correct window back up here. I'm going to stop my share for a moment and get it back. What would happen is that when we were trading in the specialist pit, the guy, because we had to provide a quote when we were a specialist, the other guy went to the restroom or, or someone was out, you would have to go over there and they'd say, I want a quote on the Microsoft August 30s. And you would have to pull up their board and make a quote, which is why it's kind of nice. The one thing about options, if you add in a fundamental view, can give a nice edge. Although a lot of this stuff you can just trade by looking at the board and the market. So that is actually my old trading post on the New York Stock Exchange. So you able to see my background there, Will?
Oh, that's great. I prefer when you go into your vault. That's my favorite.
We'll do that soon, buddy. We'll do that soon. So anyway, here's the First Majestic board. Looks like none of the August calls are offered at a dime yet. you might see what I like doing. Let's say we go to July. I bought regular July's. Well, let's click there. So here's the regular July 20 expiration, which now, so probably if you put a nickel bid into the 13 line, you'd probably get filled. One of these lines, you'd go far. There you go. You see the 15s are offered at a nickel. One quick point here that I thought would be good to point out. I've been getting this question a lot. Even when the screen is offered at a dime here, or here the bid's 75 cents, you don't always have to pay that level to get filled. So on a market, I mean, these are pretty tight, but here, this is 105 at 120. If I wanted to buy these, I'd put a 115 bid in first. And the way my setup was, I mean, I had 600 products towards the end of my time on the floor. So, I mean, a lot of this was done electronically. And let's say my Theo requires 120, and I set it was called an electronic eye. Let's say it requires, if the order is 50 contracts or less, I'm willing to do that for 2 cents of edge. So if someone is a 115 bid for a 20 lot, as soon as he puts that in, my computer would automatically hit his bid. That makes sense?
Yeah. No, Chris, just so you're aware, if you look down that volume comment on the left-hand side, if you click on any of those prices, you'll actually see where things are trading. So you could actually see if anything traded in between the markets.
Oh, wow. This is fantastic. Yeah. Well, this is why I was excited to do this today, because I knew I'd be able to learn a lot. Yeah, and this is great. So can we see which direction, whether the customer bought or sold on this?
Well, you would have to make that interpretation based on like the price and where the market is, the bid ask, right? So it's just showing you if it traded at 75 and the market was 70, 75, somebody bought it on that ask.
Here are 5 lot trades on the 80-cent bid. So
right.
Cool. Well, that's a great feature. And is this saying the implied vol came down 9.2% while the stock was up?
Yep. Okay. In that particular option. So you could see like the previous day where the implied volatility was in the market, and then those calls, if you scroll it down a little bit, we can't see. Or you could pull it, just open it up one more time, just drag it down from the bottom, like next to the close. Just drag it like that. So you see like the previous day, the options were 80 cents, 85 cents. The stock went up 0.4 and the options came in 75 cents, 80 cents. That's why the implied vol is down. So you could see the market in the options are lower while the stock is higher in the calls. That's why we're getting the implied volatility lower. So it's probably somebody, as I'm watching this, it's probably a seller in there in those calls all day.
Yep. Yeah, and that's a handy thing to have. Anything that I find one of the keys, it's, incredibly simple, yet there was, to me, something about just any sort of data that you're interested in, not only that you can see it daily, but it's in an easy place that you actually look at. So that's why having tickers and things can be helpful. Dmitry, perhaps we can remember to dig into, and am I frozen here? Oh, there we go. There were a couple features you showed the other day that perhaps.
Well, Dima, why don't you show how you can look at the vol? Maybe you share your screen in this aid.
Sure. Here, so I'm going to share my screen.
Yeah.
And also how you can select the silver stocks like you did the other day, I think would be good for people to see.
Sure. You're looking at AG Majestic. Is that the one you were looking at?
Yep.
Here, I'll just go to the options chain and kind of click around and show you. So the one thing about, and I think we talked a little bit about it with Chris, is when you look at the commodities or commodity-based companies, what you'll see is a reverse skew. And what I mean by that is that you'll typically, sometimes, not all the time, but you will see where the upside calls can be priced higher relative to the downside puts. And the reason for that is that when the commodities start moving, like inflation, they can move very quickly. So it'll be kind of like, you know, the VIX, right? That when it goes up, it could go up really fast, right? Like in the time, I think when we went to war, what was it, like oil, gold prices, they move up really quickly, right? People rush to buy gold, commodities. So what you'll see is sometimes where there's a reverse skew, and where you could compare it with the implied volatilities. And here it seems, you know, this is a low price stock, so it's not as evident, but let me see if I go out a little bit further. So you'll see typically a reverse skew. Actually, here, this is one way to see it in a risk reversal. So this is like, we're just benchmarking a 30-day risk reversal. So if you bought a 5% out of the money call, sold the 5% out of the money put, that costs a 0.2% debit. In other words, if this, think of a stock as 100, if you bought a call that's 105, sold a put 95, you would pay 20 cents. So it's like a debit 0.2%. So you could see that's a little bit different than you see typically in a stock where, like, if you went to SPY or regular stock, the skew is always to the downside because stocks tend to fall much quicker to the downside than they will go up to the upside. So I think that's one thing that we talked about, Chris, where you're looking at a skew, right? And you look for,
can you go back to that, Dima? Was that like
yeah.
the 52? It showed the 52-week average. Is that correct?
Yeah, so over here, what this is doing is this is showing the 52-week average. So right now the skew, you know, actually came in. So the 52-week average is 0.4. So think of it this way: if the stock was $100, you know, because it's all converting into percentages, but if the stock was $100, you would, you know, the 105 call theoretically is like $1, then the put is like 60 cents. You would pay 40 cents for that risk reversal to get long the call, sell the put. You know, the other way around, you would receive it. So right now, what this is showing is that the skew has come in a little bit. You know, when you see the skew going above, that means like that there's a little bit more anticipation that that stock has a potential to really, you know, spike to the upside. When you got the calls being pumped up more than the puts. So that's just kind of one thing to look out for. We also did I think one of the things we did was made a watch list for silver stocks, right? And I think I don't think I have one here, but we'll just show a way you could do it. And we'll just create one right now really quickly, and I'll just give it a name, you know, like silver. So give me some of the stocks. I know
Chris wanted to, one of the things Chris wanted to do is show how you, well, that's fine. Yeah, I got
show
it.
how you, what was it?
You wanted to see how we filtered for, we'll
Why
show
don't
how
you
you do
just
the
show
one.
how
Yeah.
people can even
let's just do that.
filter.
Yeah, you could just use this filter. So if you're on the stock screener here and you're just looking for, what was it, like silver? You know, you could just kind of start like this.
Now,
So
one interesting thing is you can hit that plus next, right to the right of the silver stocks, and that will add it to that watch list you just
yeah.
gave.
So you could just create it like a, you know, add it to one of your watch lists, or just like, you know, create a new one. I think you could just add. Yeah. You'd have to create.
Yeah, you just create
the name and then just add to it. Yeah, or say new watch list and then just give it a name, silver, and then you could just add them this way. But I think another thing, Chris, that we talked about, and it was interesting, I remember, but a lot of people may not know about this, but silver is actually used in a lot of products, right? Like we do use silver in a lot of different products. Is that correct?
Yep. And it's growing. And you can assume anything with electronics or anything you hear about going green, solar panels, all use silver.
Right, solar panels that even like, do iPhones use it?
Your phone has silver in it. Your computer has silver in it. Essentially, if we want to continue using electronics, we're going to need a higher silver price.
Right. So the consumption of silver is going to go up just naturally as the population grows and we produce more technology, more electronics. The consumption of silver is just going to continuously increase.
Any piece of data I've been able to find the last 11 years supports that conclusion. So,
Right.
Can I jump in there real quick? We got an old floor friend of mine, Scott Larison, is chiming in on YouTube, and he's asking. He's saying Dimitri's, is mentoring the upside skew. He's just asking, does that lead to spreads opportunities in SLV and GLD due to the upside skew? I thought that was maybe an interesting question.
Well, potentially, and it depends, right, on your outlook. So if you think, it depends which way you think that the stock is going to go in that hold period. But yeah, I mean, look, when we were even trading, a lot of people really paid attention to the skew and traded the skew. So risk reversals and the skew were very popular when we were trading on the floor. So it can lead to it could definitely lead to an opportunity. Here, let's just take a look at another one. Let's just see what the skew is in this one, PAAS. I just picked the higher priced, the higher priced options. So let's just go out to January, and if you feel like here's the skew here. I mean, this one is kind of pretty flat right now. It looks to me like it's just kind of a flat skew. Basically there is no skew.
Now can we see? I'm sorry. With that flat skew, quickly, how do we look to see where it rates to its 52-week
historical? So over here, yeah. So it's pretty flat, like a 0.2%. So let me just see the longer term ones. I think we have like. Let me see if they're going out. Oh, wait. This is the risk reversal. So let me just go out here like 60 days, 90 days. So the 90 days is a 0.6. So you see as you go out further that skews more dominant because it's giving you a higher potential probability that something like Chris is talking about may happen, right? Where it could be it could be just an event that creates that demand. Is that right, Chris? It could be like I don't know, like a geopolitical event.
Well, theoretically it should be. I don't find that's usually the way these things trade. I think basically you want to know what's going to happen with the price. Look at what's happening with the paper on the COMEX. That's why I found it so intriguing and why so many come to the conclusion that wait, there's something bizarre here because even the Fed announcements, silver reacts rather counterintuitively to what you would imagine. Dmitry, can I take the screen share back for a moment?
Yeah, no problem.
I'll show an example of it. I know we're going to take some questions. So I'll wrap up two last things here. So here you have First Majestic, 942 at 44. Let's call that 9.5. So dollar out of the money put would be the 8 line. So we see that's about 115, 120 versus $1.50 out of the money call, $1.35, $1.50, which is not usually the case in most other stocks. Usually what will happen is that the skew will be set to balance the order flow. I'm guessing that the market makers running these quotes here are probably not digging in depth into silver, but just are balancing order flow. And that's usually how those skews are set, which is what to me creates an intriguing opportunity. Let us go back to, here's the July. So it's expiring now in 15 days, although I did this about a month ago. So we had a month and a half of time, and I bought the 16 line first for a dime, then First Majestic dropped. I got it for a nickel. So again, a lot of what I'm mapping out here is based on the probability of expecting a big move. I think you're running fractional reserve schemes on the underlying bullion, and it's a matter of time. Again, factor in your own assumptions. But let's say we had the 16 line here, and First Majestic did just even what it did. I think it's pretty darn conceivable that given that the Fed is doing unlimited printing, silver supply going down, now we're hearing rumors of COVID round 2, which of course hopefully does not happen, but that's surged. Big increase in demand. People couldn't get product. Premiums shot up. So let's say silver even gets back to $20 or $21, which given how gold is approaching its all-time high, and silver is not only a third of its 2011 high of $49, it's a third of its 1980 high of $50. So any fundamental factor you're going to look at indicates a higher silver price. But let's just say First Majestic got back up to that $18 level. Well, if you paid a dime for that 16 line, your intrinsic value is $2. So $2 over a dime, you got 20 to 1. My math correct there, Will?
Seems good. If it's not, someone will let us know. That's for sure.
So $2, yeah, you're getting 20 to 1 on your dime. If you paid a nickel, then you're getting 40 to 1. So that's why, you know, especially if you do this, any of these lines, I definitely. Now, if you think that there's going to be a failure on the COMEX, which personally I do, again, you got to feel that out. Although that is what the book gets into.
Jesus, there's an angry bear behind you. Watch out.
Well, that's Frank Maiolo. Yes, which I think he might have been an angry bear. But I guess if you imagine, let's say I'm correct and silver does go back to 50, given the leverage we walked through before, to me, it seems pretty darn plausible that if you had silver above 50 for an extended period of time and that kind of leverage, that would we see, perhaps just to make the math easy, let's say First Majestic went up almost 1 to 1. If you had a $56 First Majestic price on the 16 line, that means your option's worth $40. So if you paid a dime, you're getting a 400 to 1 multiple. If you paid a nickel, you're getting an 800 to 1 multiple. And last month, I put that on a month and a half out. So let's say you have 8 1.5 month periods in a year, and I put just $1,000 on it each month. So if I get them for a nickel, if it happens in the first year, you know, your payout would be $800,000 versus, you know, if you paid the full year, $8,000. 2 years would be $16,000. So you see, if there is a big move coming, which to me, forget about whether there's a short squeeze, forget about whether it's, you know, bankers selling paper, gold, and silver, and there's 500 people who think they own every ounce. I mean, forget about the fact that gold's crossing its all-time high, about to become a mania that the Fed is guaranteeing, because in the end, the Fed, they're guaranteeing the metals are going to go up. And I would say I can usually don't issue guarantees in the financial markets, but the Fed will never raise interest rates under this financial system. You saw what happened in the end of 2018. So I think they're just going to continue to printing. And that's why, you know, I just continue to back out the insurance and I leave this on. I'm prepared to leave this on for years. I mean, I've done this on and off the last couple years. But unless I can see some way in which that's not inevitable, anyway, that's one way I approach it. And if there's any questions, would be happy to take those on any topics.
Well, one question is, I hear copper is a leading indicator in the metals. Why do you choose silver?
That copper is a leading indicator?
Yeah. Is that's wrong? Do you even look at copper?
I look at copper sometimes. It's interesting, really, that same pattern that you've seen with silver kind of broke a little bit last year, but there's you can look at the commitment of traders reports. Usually when the banks get really short, the price comes down. Then when they get flat or even long, that happens in copper too. I hear there's a structural deficit in copper. So I think it's a similar situation. I think copper production should be a leading indicator because 70% of the silver comes as a byproduct, primarily copper, also lead, zinc. But to be completely honest, for the last couple of years, the only thing that I think has been determining the price is what's happening with wild leverage on the COMEX. And that's why, this isn't for everyone. A lot of people want to know how to trade it up over the next couple of months. And certainly I've been there, and that's fun in its own right. But if you like the Big Short and what they did and how you can get some interesting multiples. I mean, I've backed this out. You could even have it on for like 20 years and you're in quantum fund territory. So, I also find it interesting. You find one expert after another. People like gold. So to me, it's, but it's a funky market that sometimes you got to wait a decade or two. And fortunately, we're already 9 years in, and there's a lot of signs that, this thing is coming close. By all means, don't spend your mortgage money, or really the key for what I just outlined is that if your option does not pay off, if you are excited, because to me, it's like, wow, if they keep buy options and this thing doesn't blow this year, all right, that means they had to put more paper, more leverage on this to keep this thing stuffed. So if I'm buying these same options again in January, I'm thrilled to be doing it because I believe my payout is going to have to be some multiple higher the more paper you pile on there. If you're not able to feel that way, then you're putting it on too big.
Very cool. For anyone who cares, I just got another YouTube piece from Scott Larison, who's letting us know that FCX is an excellent name that tracks copper, if anyone has any interest in copper. I'm going to give you another question, Chris. It's about the microcap miners. Is there anything about the microcap miners you like, don't like, stay away from? Any ideas?
Well, the one thing is that a lot of the junior miners aren't even going to have options listed on them, which is a shame. I mean, man, if some of these penny stocks had options, although they do have SILJ, I believe it is, the Prime Junior Silver Miners ETF. So let's take a look at this bad boy over the last year. Basically, you had silver rally last July through September. So I'll bet this thing went up quite a bit there in July. 869 to September was 1136. So I don't know, like 30%. I would almost think it'd be more than that. Although one thing to keep in mind that's interesting is that a lot of the gold stocks have really done well over the last couple months in particular. A lot of these silver stocks are still well below their highs of the last year. Here's the Silver Miners Index. We'll pull that up. 1 year. So, I mean, well, even the silver stocks are kind of...
They have made a run back.
They're getting up there a bit. So, but I mean, I still think there's, when it really starts to move, and again, I'm curious once gold crosses, where's gold today? I mean, we know that people trade on momentum. They trade a lot of leverage on momentum, and they buy after things are moving. So I think we'll see it when gold crosses 1800. But I mean, we're talking about a world historic event once gold crosses 1900 and 1920. I mean, that's, yes, partly financial, but I mean, you're going to see it back on the CNBC ticker, and all of a sudden people are talking about gold. And then I just imagine the trading desk will be like, hey, Bill, what's that Sliver. Oh, silver. It's up 40% today. I mean, at some point, especially because the market is so small, I think you're going to see gaps up when probably, I know there's an investigation going on where they've already gotten guilty pleas. I've done a lot of intriguing research into that topic. That's what the book is about as well. Maybe a regulator will wake up one of these days. My guess is this will go on until there's enough demand for physical metal. And at some point, you're going to see, hey, we don't have the metal. That's essentially what happened in the gold market back on March 23rd and 24th. I believe it'd be safe to say there was a failure to deliver in the EFP market, which is the exchange for physical, another paper derivative. And that was the same day Bernanke, Powell, they're all the same. That was the day he announced that QE had to be unlimited. So if there's a second wave of COVID, or even the next time the US wants another couple $1 trillion stimulus deal, I mean, they're buying ETFs. They're picking corporate bonds. They've made it clear they're going to print everything on the planet. So I think the silver market is going to pop somewhere along that journey. And anyway, I'll stop there and we can take some more questions if you'd like.
Well, for everyone, I'm putting the link to your book back out there, because for anyone who wants to know everything about your thought process, do yourself a favor and grab the book. We did have another question it's a question from Klaus, and it's about, instead of buying a cheap upside call, maybe looking at a 2x1 call spread, sell one call and buy two calls lower your carry cost, buy 6 months, roll every 3 or something. Any thoughts on maybe a back spread?
Where did my Market Chameleon window go? How about Dmitry? I'll let you take the screen, and in case there's any features you want to show as we go.
Dima, if someone wanted to look at the call back spreads,
I mean, there's infinite ways to go ahead.
You could even use these benchmark, like as we did. These are ratio call spreads, and this is showing you like buying 2 calls versus selling 1. So right here, you're paying a 2.5% debit. But again, that's shown. What the back spread is you're selling, and you could do the opposite of this, but selling 1 call, buying 2 calls on a different strike, a higher strike. So this is right now where it's at, but I'm just going to show for those people wondering what that means is this is how it would look. You would sell 1 call, like say the 370, and then you would try to go up and buy 2 calls. So I'm going to do that ratio. See, selling 1 October 16th, 28 call, and then I'm buying 2 of the 34 calls. So let's see what that looks like. So the idea is if the stock goes way up, you'll start making money on that second call eventually. So you're selling a call spread, buying an extra call. So if it goes way up, you start making. If you could get this for a credit, that's even better. So let me just see what that would look like. If you were able to do it for credit, I'd have to like move up. Yeah, let me just move up strikes just to make it easier. But let's see if you did the 40 strike. So see here, you're collecting a credit because you're selling 1 for 370, buying 2 for 95 cents. You're collecting credit. If the stock just sits there, it's $1.80. So you're receiving. If it drifts lower, you're still getting that credit. So if nothing's happening, you still can make money. If it just drifts higher, you start losing. But the idea is like if it really whips up, you start making it back up to the upside.
Excellent.
That's what a back spread would look like.
You answered the man's question, Dima. Awesome. So we're pushing up against the hour, Chris and D. Chris, you want to talk about? Well, first of all, you got to go to your vault, I think, to grab the coins.
Well, I got to keep this hidden from the COMEX sometimes. It's like you never know when they're going to be scrounging around. One quick anecdote on silver I thought was odd. Eric Sprott mentions how one of the largest dealers was calling him asking for 1,000-ounce silver bars one indication to me that supply is tight. But I'm stocked up back here. So Will, if you want to come on over, we're all, it's nice and warm here. You can sleep on some silver bars and we'll be all good to go.
Next time I'm out west, I'll do that. So what I'm putting the links to your Twitter handle and to the Market Chameleon Twitter handle on the chats of both YouTube and the meeting we're having on Zoom. Remember, if you're on YouTube, please like us and follow us, as well as go to Chris's YouTube channel. I've put the link within the chat, and subscribe. Very helpful to us, and super important for us to spread Chris's world, let people know about the Market Chameleon. So what do you want to do with these gold coins before we go, Chris?
Well, these are silver ounces.
Or silver,
here.
sorry.
We have 2 Noah's Ark coins, nifty little design on the background that we are going to give away to 2 viewers today. So if you go onto Twitter and Will, is this already going? It's already going live on YouTube. So
yep, it's live on YouTube. They're aware.
If you take the YouTube link, share it on Twitter, tag Arcadia Economic. I couldn't fit the S in there. And Will, your Twitter handle
is Market Chameleon at Market CHLN. I put it out there, CHMLN.
So if you tag this, by all means, only if you found it helpful. I mean, hopefully gave some ideas to think about and also some new features on the Market Chameleon. But if you enjoyed it and found it helpful, we're going to take 2 people who share the interview with those Twitter tags and send them a nice fresh ounce of silver. Because part of it, you know, I know there's the gloom and doom crowd, and I don't know, maybe we'll all be shooting each other in the streets next year. But I mean, it seems like a hard way to live. And I think there's a lot of good that's going to come out of this. And for all the talk about silver as money rather than hoarding it, I think there's something to making it fun. So get a couple people going with some silver to, you know, build a collection and track some more silver in the future.
Very cool. Very cool. All right. So, you know, we'll follow that Twitter, and I'll have Chris send that out. That was very nice of you, Chris.
Yeah. Well,
Thank you, Chris. Thanks for joining us today. And thanks everyone for joining.
Everyone loved the show. Again, you know, follow Chris, follow Dmitry, follow me. You follow Dmitry and myself through the Market Chameleon Twitter feed. And we hope it was helpful for everyone. Super interesting. I can't wait to get to the book.
well,
Very
appreciate
cool.
that. Will, could I make one last comment?
Certainly.
Tied into that last question, and also something I heard Dmitry mention in a webinar sometime last year, where that to me is one of the fun parts of options, where you can do ratio spreads. There's so many specific ways you can express a precise bet, whether it's silver or anything else. I mean, maybe you could do this same strategy we outlined if you think the stock market's a bubble. And I like what Dmitry mentioned in a call a while back, where it's like, find what suits your personality. You can do what fits you, not what fits me. That's what I find beautiful about options. And again, thanks for having me here. It was fun to share this and dig in today.
Hey, it was great. And everyone's saying they enjoyed it.
Thank you, Chris.
So, very cool. All right, everyone, have a great week. Dmitry and I are not going to be here next Monday. I will be away on holiday. We're going to be back on the 13th of July with Dan Passarelli, which should be interesting. And with that, have a great 4th of July. Chris, thanks again. Dmitry, as always, a pleasure and super helpful. Thank you,
everyone,
for joining us. Have a great night.
Thanks for watching.
Bye-bye.
Thanks, Chris. Bye.